Hello, everyone. Thanks for thank you for watching and thanks for all your questions that you asked. Um, yeah, so today we're going to be talking with Ray Diaz. He's our in-house mortgage specialist, and yeah, no, he's awesome. Oh, hey, Ray. How do I let you in here? And I Perfect. So I'm just gonna let you in here.
You. Perfect. Hey,
Hey, how you doing, Chantelle?
good. How are you?
I'm good, I'm good. This is my
Long time no.
first I know. This is my first Instagram live. Is it yours?
Yeah, mine too. So should be good though. Looks like we have a couple viewers. So hey, everybody.
Hello, hello.
Okay, perfect. So yeah, like I was saying, Ray is he's our in-house mortgage specialist at our office. He's really awesome at what he does. And so Ray, why don't you introduce yourself a little bit?
Hi guys. Again, my name's Ray. I've been in the mortgage business for many years. So around 14 years. We have a team that I'm leading with Mortgage Alliance. Our team is called Expert Mortgage Agents. And like I said, we've been in this mortgage business for many years, and certainly I appreciate working with somebody like Chantelle. Somebody of her quality, her character, and certainly expertise. So we're all
Thank
lucky
you.
to have you here too.
Yeah, thank you, thank you.
Perfect, perfect. Now,
So
if, sorry, go
oh,
ahead.
go ahead. Did you want to like dive into the questions or how did you want to do it?
I do have actually somebody sent me a question here about you, and it's actually something that I'm curious about. I wonder what your origin story is as a realtor. How did you become a real estate agent, and what do you love about the real estate business?
Okay, cool. Thanks. Well, in 2015, I went to Australia. I lived there for a year, and so that's when I first kind of got introduced to really nice like houses and stuff like that. Like there were some houses literally that had like tennis courts in the yards and stuff like that. So I thought it was really cool. And then when I got back from Australia, I wasn't really sure what I wanted to do. So I wrote down a list of things that I was considering. Um, one of them was a realtor, obviously. Another was I was considering being a psychotherapist and those sorts of things, right? And then so kind of figured out that being a realtor would be the ideal kind of scenario for me. So that's what I ended up choosing.
So, what is it about being a realtor that you love?
Oh, so like I just like love working with people.
Yeah,
I've worked in the hospitality industry. Like pretty much all of my jobs have been in the hospitality industry. So yeah, I like working with people. I'm kind of a people pleaser to be honest. So I like just providing people with good service and seeing smiles on their faces and getting things done for them. So yeah.
that's awesome. I can attest to that because I know that a couple of the referrals you've been able to send over our way, they always love you. They talk, the world about how great you are, and certainly I think being a people pleaser now it makes sense.
Yeah. Yeah, thanks.
Yeah,
Okay.
perfect.
Sweet. So I guess yeah, we got a lot of good questions in. So I guess I'll start with one related to mortgages.
Oh,
Surprise, surprise. So they were one of the questions is what's the ideal down payment needed? Sorry, I'm reading because I wrote them down here. What's the ideal down payment needed to get the best mortgage rates?
that's a good question. There's certain minimum down payments that we require getting into, if you want to consider buying, but there are certainly uh, down payments that if that's the size of down payment that you have, they'll help you get the lowest rate. So there's two categories. One is if it's high ratio. So mortgages with less than 20% down has to be insured. And if it's insured through either CMHC or SAGEN or Canada Guarantee, it actually lowers your interest rate. Now you do have to pay the mortgage insurance premium, but because it's less risk for the bank, they offer us low rate on that. Now, the other category for the lowest rate possible is if you're putting 35% down payment or more. Again, based on risk from a bank's perspective, if you're putting so much down payment, it makes it less risky for them. So they offer the best rate. So less than 20% down or more than 35% down.
Okay, that's actually interesting because I didn't realize that. That's good to
People
know.
don't, yeah, people don't know. Certainly, rates is one piece, and it's a good question. Thank you.
Yeah, yeah, no worries.
Now, is it okay if I ask you a real estate question?
Yeah, yeah, for sure.
Okay, so I have one here that somebody sent. We hear that we hear that it's a hot seller's market right now. What good strategies should buyers have given current markets?
Yeah, so it definitely is a really hot market right now. I mean, pretty much most homes that are on the market are going into multiple offers, and it's yeah. So I'd say one important thing is definitely to get pre-approved, because in this type of market where it's really competitive and everything, you want to kind of know what you can afford going into it. That way, if you have to go in without the condition of finance, you can. Another tip I would say is like don't have your expectations so high. Remember that when you're as a first-time buyer, for example, when you're buying your first place, it's not going to be your forever home. It's more of a stepping stone, right? So it doesn't have to be perfect.
Yeah.
And you probably won't get the first one. You might have to, lose a couple to get the right one. So yeah, don't have your expectations too high. And it's about time in the market, not timing the market.
Well, having an expert like you, I'm assuming, helps too, right? To make sure that
Yeah.
that you're able to set the right expectation. And in all honesty, on the financing side, I do look up who the realtor is that's that represents our buyers, because you want to make sure that they're getting the proper advice. And like I said, I've worked with a couple of your clients yourself. I know that you do. You've got their best interests at heart, and certainly your expertise shows.
Yeah, thank you, Greg.
Yeah.
Okay, so I have another question for you. So, let's go with. So, is it harder for a self-employed person to get a mortgage?
It really depends. Self-employed, you typically need to be self-employed for more than 2 years, 2 to 3 years or longer, depending on the lender. So that's an immediate qualifier, right? It's like, okay, well, if you just open your business and you're predicting you're going to have a $2 million sales revenue, well, because of the fact that it's a new business, it might not be something that's easy to finance. So that in itself makes it a little bit more difficult. But if you claim a good size income, you're as good as everybody else is. Now, obviously, the challenge on some of the business for self components is that, somebody that has, let's say, an incorporation in terms of business, they might not claim all the income for this year because they can defer. They can put off the income for later years. Now, if you've got a scenario where you have lots of expenses or cash component to your business, that could be a challenge. So there's certain avenues where you go, we got to watch out for these things. But certainly, if you've got a well-established business and reporting good income, you can borrow as much as everybody else is.
Yeah, and that was Stacy's question. So she's like, yeah, I've been in the business for 2 years, so that's great.
Oh, perfect, Stacy. It's time to buy now.
Yeah. Okay. Can I ask you another question? So, let's see. Okay, so this one's kind of what is the process of getting pre-qualified or pre-approved? Like, how does that whole process work?
It's actually pretty simple. Now, I usually suggest having that as one of the first or early steps into buying. It just sets the expectations that you're not, overreaching, for the properties that you're looking out there. So if you do start looking at properties before you're pre-qualified, you might be looking at properties at, 1 million, but your affordability can only get you to an $800,000. So it does set you up for some disappointment there. But the process of the pre-qualification is actually fairly simple on our side. there's really three main things that we look at when we're approving a mortgage. Now, on the pre-qualifications, we've concentrated on the first two things. So, one is affordability. In terms of affordability, we look at your income, we look at your credits, we look at the source of the down payment. So not just look at it, we actually get the proof that, with pay stubs and T4s and letters of employment. So we know how much income we really have to work with. Some people, when you talk to them without the proof, sometimes the people says, oh yeah, I make $100,000 a year. It's actually $92,000. We tend to let's say round up when it comes to income, and for expenses we tend to round down. So that's why we need to see the proof, because again, it could mean that you can get to an $850,000 purchase price versus maybe a $900,000 purchase price. So affordability. So we look at the income, we look at the expenses, we look at the down payment, and then the second thing is credit history. So we went from affordability to credit history. Now, credit history basically tells us your likelihood to pay your financial responsibility. Affordability tells us the ability to do it. Now, the last thing is the property. On a pre-qualifications or pre-approval, we don't get to check that until we have a live deal. So the first two things, affordability and credit history, and it's actually that simple.
Oh, it looks like we have a question. Wait, I hear you shouldn't make a big, or you should, where did it go? I hear you shouldn't make big purchases before buying a home. What's expensive?
Yes.
That's a good question, actually.
That is a very good, timely question, because we usually say, if you're looking to actively buy now, there's a couple of things that you shouldn't do. Don't get that nice Mercedes-Benz that you've always wanted. Hold off until we get the purchase of the home. Don't change jobs, right? Or don't quit your job to start own business. So there's a few things in there, and that's a good one. The big one is don't buy any expensive credit.
I would even do like furniture and things like that. Like if you're going to use your credit card, like say if you you put an offer and your offer gets accepted and you're all excited, you're like, yes, like I'm got a house. Like I would not go and buy all the furniture that you plan on using, because they're gonna Ray will be checking that at the end too. If it doesn't match up, then they won't like that. So
and that's exactly, that's a very good question. So we faced that before. So we do remind our clients to make sure and say, hey, Chantelle, it's great that you're approved now, but it doesn't stop there. We got to get you to the finish line, and the finish line means that don't change your income, don't change your current credit and stuff. Don't, make sure that you're still making your regular payments, at least the minimum, and that expenses is a big portion of what we look at in approving, right? Is it okay if I ask you a question? I've got another question here.
Yeah, for sure.
Okay. Have you seen more and more buyers consider areas outside of the immediate GTA, and why?
Yeah, have I seen buyers consider areas outside of the GTA? Yes, I have. So especially because the GTA it's just getting so expensive, right? So what I've been seeing a lot of first-time buyers do is kind of go to the suburbs, and even the suburbs of the suburbs. So say areas like Kitchener, Cambridge, Orangeville, Hamilton, those sorts of areas. It's a little bit more affordable, and so your money just goes further. So say if you were going to buy a $600,000 one bedroom condo downtown, for some it makes more sense for them to buy something in Cambridge, 600,000, and maybe you're getting a townhouse. So you get something a little bit better, not better, but you get something with a little bit more space for the same price. So, but at the end of the day, it comes down to where you're working, and those sorts of things.
How far have you gone? Taking a client, how far have you gone?
Well, I had one investor client actually, and they bought in Ottawa.
So remind me again, how far is Ottawa from where you are?
Yeah, no, but okay, so that's a long story. I have family who live out there too, so I just went and stayed with my family. But yeah, that's the furthest if you really want to know.
We've got
Oh,
we've got a good
another.
question there.
What does this say? Hi, Kira, by the way. Would it make sense to buy a small condo and rent it out, and then to rent a bigger place and live in it, and then rent a bigger place and live in it? That's a good question. I feel like it would really come down to the numbers of everything. I think Ray actually was gonna ask another question that's kind of similar to that, so I'll just kind of address that
Yeah.
now. So he was gonna ask, buying a house that say has two units. So say
Multiple units. Yeah.
you can live in the upper unit and then rent out the basement. I would say that would be something I would lean towards more than actually buying something, renting that out, and then renting somewhere else. Because
Yeah.
that just kind of seems like a lot of different steps, right? Whereas I feel like if you just buy something, that's not multi-residential, but has two units, say you live in the upper floor and then you have a tenant live in the basement, they'd be paying, a significant amount of your mortgage. So you'd have less expenses, and it'd just be a good situation. The cons of that, though, I'd say the cons would be that obviously it's a little bit less privacy because the person's right there.
Yeah.
Right?
Do you think, have you seen a little bit more demand for those kind of properties out there? Because I mean, they don't typically come in through the builders. They're really mostly resale properties and stuff. And
Yeah.
I think it's a good tactic to get into managing your cash flow. But does it make it more, I guess, attractive for more people? Does that make it more competitive, I guess, if you want to look for those properties?
Yeah, no, it definitely makes it a little bit more competitive for sure.
Perfect.
Um, but no, that's a good question, Kara. I've never had anybody actually do that, like in my personal experience. So, but yeah, it's in theory it would make sense, but it does seem like a lot of moving parts. So,
We've got a good question down here. It says, could you get a larger pre-approval if you show you'll be renting the basement? The quick answer is yes. We're able to use the additional income from the basement. Now, it has to be a separate unit though. So when I say it's a separate unit, typically it means separate bedrooms, separate kitchens, separate bathroom. You can have a joint laundry room, but ideally separate entrance.
yeah.
Some lenders require that it has to be a legal basement apartment. Some lenders, as long as you have those pieces, they'll still approve it. So the additional income definitely helps for pre-approval purposes.
And so, question on that question then.
Yeah, of course.
So with the amount, so say if you're renting the basement out, say for like a 1,500,
Yeah.
like would you be able to put that whole amount towards
Some
the
lenders
income?
will go up to, most lenders will go up to 85%. Some
Mhm.
lenders go up to 100%. Actually, yeah, we have a lender that would go up to 100% because it's owner occupied. Some lenders, a lot of the lenders will go 50.
Okay, cool.
Yeah. But again, one of the things that it would do is that it adds on to your income that we can use to calculate your ratios and stuff, right? No one wants to
Yeah,
pay
so
mortgage.
put a little bit more. And
Perfect.
then, so yeah. And I feel like the piece of having somebody kind of pay part of your mortgage for you, like a good chunk of it, that's the part that's really attractive to me anyways. Like I
Yeah.
would do that.
It just makes sense, right? When you're looking at those kind of scenarios where you're paying for the mortgage, obviously, but you have somebody else maybe, takes half of that payment or even more than half of that payment, that's a good relief for your own personal income, and maybe you still have the ability to save for any other future investments that you may have, but at the same time, you're already a homeowner. So the capital appreciation on that property just works. So economic benefit of it is definitely ideal.
For sure. Yeah, time in the market, not timing the market. Yeah,
You're right.
yeah. So she just had another question. Even
Yeah.
though it's projected income.
Some lenders would do what we call market rent on it. So if you don't have an existing lease, we, depending on the loan to value, we can actually send an appraiser to evaluate the property value, but also help us figure out what the market rent is for that basement or for that rental property. So yes, we can do that with some lenders.
Okay, cool. Does this concept work if you replace basement to a separate unit in building?
Um, if it's a duplex or triplex or up to 4 units, it's going to be considered under a residential borrowing component. Anything over 5, it'll be yeah, multi-unit residential. But again, from that perspective, it's technically it has to be one property to be considered as such. Now, if you're in the same building, so let's say you bought a unit in the building and a second unit maybe above you, below you, but it's in the same building, those are treated as two separate mortgages, two different qualifications. But certainly we will count the rental income to maybe offset some of the expenses on the rental unit, and then we still have to qualify your income for that mortgage that maybe you're buying for yourself.
Yeah. Okay,
Perfect.
awesome. That's good to know. So
Yeah.
I have more questions for you.
Please, please.
Okay, where's the question? Oh, okay. So what is the first time homebuyers incentive and how does it work?
It's actually one of the newer incentives that's been brought out there by the Canadian government. What it does is that it helps people get additional down payments for their purchase. Now, it only applies if you've got less than 20% down. So that's one first thing that you need to know, right? But you still need to come up with a minimum down payment for it. So if you're buying something for $500,000, you still need to make sure that you've got 25,000, which is 5%, which is typically is the minimum for $500,000 purchase or less. Now, when it comes to the home buyer incentive, the government will top up another 5% or 10%. So if it's a new build purchase, it's either 5% or 10%. For resale, it's 5%. You only have the 5% option. It's repayable back within the 25 years. But what it does is that it lowers your mortgage payment because there's zero interest incentive there. But like I said, it's repayable back to the same percentage of how much you sell the property for. It seems like a lot of verbiage there. All it is that if you bought something for 500,000 today, let's say, and it's a resale property because you went with Chantelle, you're going to come up with your minimum 5% down, and let's say the government gives you an additional 25,000, which is 5%. So conceivably, you've been able to put 10% down in total there. Now,
Yes,
10 years from now, yeah, go ahead.
insurance.
Sorry, say it again.
So you'll pay the mortgage insurance on the 10% instead of the
Yes,
5.
yes, you pay insurance on the 10%. Now, the only thing though is the catch is that now the government is a shareholder or an equity stakeholder of that same property. So let's say
Yeah.
10 years from now it's worth $1 million. You don't just owe 25,000. You basically owe 5% of $1 million. So ultimately you owe $50,000. Now it's a good incentive. There's
And
maximum amounts. Say that
I
again?
think it works both ways though too, right? Like say if the property value dropped, which I don't expect that to happen anytime soon, but say if the property value dropped to 400,000 from 500, then you owe 5% on the 400.
That's correct. So
Yeah.
so for markets where it's flat or going down, obviously that may be to your advantage because technically it's going, well, not ultimate advantage, but certainly your borrowing that you have to replace or what you have to replace through the first time home buyer incentive goes down as well.
Yeah.
There's a few tricky things in there, but you need to kind of know certain details because if you're looking to buy a $500,000 and put $200,000 as renovation, well, that means that now the property could be worth $700,000 or over. Now you basically, the government doesn't share the additional expenses for renovation. But if you sell it for 700,000, 750, or even $1 million, you still technically owe the same amount, the same percentage amount.
Yeah.
Perfect.
Sweet. Awesome. Did you have any other questions for me, or can I keep asking, keep drilling them into you, or?
I don't have any more questions from the ones that were sent over. But
Okay.
tell me, based on how I forgot, how long have you been a real estate agent?
So I've been in the business for about 2 years now, actually. Yeah, yeah. So still fairly new, but I feel like lately things have definitely been picking up, and yeah, I'm really happy. So
Or
yeah,
what do you think is, if you're talking to somebody new that's just trying to get into the business today,
yeah.
or maybe even yourself, if you were talking to yourself 2 years ago, what would you say, what would be a suggestion? What would be a recommendation that you'll have to, give yourself 2 years ago and say, watch out for this so that you don't make these mistakes, or maybe
Yeah.
something like maybe focus on this because this is going to do us really, really well.
Yeah, honestly, I would say make sure you interview a few different brokerages, and make sure, yeah, to see where you kind of fit the best. When I first got into the business, I was at a different brokerage than I am at now. I love my brokerage now. Like Royal LePage out of town is honestly the best. Like if there's any new agents that are getting licensed, I
Yep.
definitely recommend joining us. But yeah, I would say definitely pick a good brokerage and yeah.
Can I ask you one more? It's just something that just came up.
Yeah,
Um,
sure.
Obviously, we're still in the middle of a pandemic, and things are opening up a little bit. I think starting Monday. But how have you changed your business prior to the pandemic, prior to the COVID, to where we are now? Has there been what would be something that you've operated differently? Do you use more technology? Do you use more of these video things to talk to clients or show houses and such?
Yeah, yeah. So there's been a lot of virtual, a lot of like DocuSign or ThinaSign, like doing deals not even on paper anymore, just virtually. So that's pretty interesting. I also, yeah, I've been doing a lot more like on social media, trying to obviously brand awareness and stuff like that. Also for like when showing homes or when I have a listing, I have kind of like a little COVID packet, I call it. And,
Yeah,
comes with masks and gloves and shoe covers and all of that good stuff, sanitizer, just to make sure that everybody in the situation is protected and safe from the virus. So yeah,
that's
yeah.
awesome, and that's something that you provide for every client you have.
Yes, yeah, yeah.
Oh, that's awesome.
They're in my car, otherwise I would show you them, but
Perfect. Do you have any questions? Any more questions, or did we get all the questions
um,
out there?
I think we have, okay, so there was one, okay, so I have two more questions, or actually, I have a few more to be completely honest with you. So what are the standard rates right now?
That's a again, it's a very relevant question because we've been seeing a lot of rate changes actually last week or this past week. Um, well, this past week we've seen 10 to 30 basis points increase on our fixed rates because of the Canada bond yield. So our current fixed rates are a little bit over 2%, right? And 2 to 2.19 thereabouts. Variable rates, as the fixed rate went up, the variable rates actually went slightly down. So you'll see variable rates anywhere from, let's say, around 1.5%, 1.5% more or less. Obviously, it makes a difference when we're looking at, people look at the rates and it's that shiny object that people always wants to see, right? Like when we heard that one lender lend at or starting to produce marketing materials at less than 1%, everybody knew about it. We got calls after calls, every single client's asking about that lender. I don't want to repeat it, but
Yeah,
certainly
I can imagine.
it's yeah, everybody knew about it. But I always tell my clients, you need to spend as much time or even more time uh, talking, discussing about products, because it'll actually, as much as it's nice to see, a really good rate going in, but your overall cost could be the exit strategy, right? If we put you in the wrong product, you're actually, ultimately costing you more because, you went on a long-term 5-year fix and you were looking to sell it after 2 years. It's probably So that may be something that's going to cost you in the end.
Yeah.
I'm just reading it too.
I know.
Oh, perfect.
Yeah, no, that's super good to know though. Just two more questions and then we can wrap it up. So about credit score.
Yeah.
So if somebody say has a low credit score, how does that affect them in terms of the down payment and the rates? And then also, does them having a lower credit score say affect their partner's ability to buy too? Like say if one has good credit and one has maybe bad credit, like how does
Yeah.
that?
So there's different qualifications of lenders that we have out there. So if your down payment is less than 20%, typically we look at the A lenders. So that would be the banks and the major financial institutions and obviously the mortgage insurer to qualify. They have different minimum credit scores that you need to have. So, for instance, if you have 5, 10%, less than 20%, we need at least one individual to have at least 680 beacon score. Okay, so if it's a couple, one is a little bit under 680, but one is over 680, that may still work. Now, there's typically let's say an entry credit score that you need to have. It's around 600 to 620 at least. But again, the other partner needs to have at least 680, especially if it's a high ratio deal. Now, if you have 20% down, we can still go with an A lender when your beacon score is over 600, so it's going to be on the lower side. But if your score is way under 600, so just so you know, the lower the number, the worse it is, the higher the better. But if your score is under 600, we basically will probably have to go through a B lender. So a B lender will give you a little bit higher interest rate, not so much more, but a little bit higher interest rates and some fees. So lender fee, broker fee associated with it. But again, we look at it from that standpoint and say, hey, if you have a certain issue with credit, maybe it's an isolated incident, we look at maybe getting into the market. Like I said earlier, it's not timing the market in terms of home ownership. Usually get in and how long you're in there. So sometimes getting on the B lender side, if you have a lower score, is better than getting in today, better than having to wait 2 years or a year to when your score is better. So we usually go with a B lender, put a plan together, maybe graduate you over to an A lender afterwards.
Okay, cool. No, that's really good information to know for sure.
Thank
And
you.
then I think just one last question and then we can wrap it up. I know I'm just gonna keep adding one more.
I'm all yours.
Yeah. I know, too bad we don't have those shots of tequila right now. No, I'm just joking.
Yeah. And for people that weren't in here before,
Yeah.
I guess before we started turning it on, I was telling Chantelle for our next live we should have tequila shots. Yeah, exactly. Every question will be a tequila shot question.
Yeah, why not, right? When in Rome. So the last question is, how does the RRSP, the buyer's plan work, the home buyer's plan?
The home buyer's plan. So a home buyer's plan actually went up in terms of the limit to $35,000 per borrower, right? So if there's two of you, $35,000 each, you can actually combine. You can combine up to $70,000, right? It is a first-time home buyer incentive as well, not an incentive, a first-time home buyer scenario. There's some details in there where a first-time home buyer may be somebody that's separated before or been owned the property but been renting for for the last 5 years and such. But if you're considered a first-time home buyer, you can take advantage of the home buyer plan where you can take RSPs from your RSPs to use as your down payment and closing costs, and then you have to just repay yourself back within the next 15 years. You get the first year as a break, but the next 15 years after that, you have to repay it. Just make sure that you've had that RSP contribution for more than 90 days. I usually say 91 days, but it's really 90 days.
Yeah, so it's really for like people who have already contributed to their RRSPs.
Yeah.
Because if you haven't contributed, then there's nothing. There's not money there yet. So yeah, you have to have money in your RSPs to be able to take the
Yeah,
money towards it.
yeah.
But I think, yeah,
It gives you a couple of benefits, right? So it's like, okay, well, Chantel, you're planning on buying a house and you're a first-time home buyer. You take $35,000 out of your savings, put it into an RSP today, and you get the RSP receipt. Actually, not today, a couple of weeks ago, because it's the RSP deadline is done. Yeah.
oh yeah, true.
Yeah. So, but you can still get a receipt today for next tax year, for the 2021 tax year. But
Yeah,
you get the tax receipts. You can get that, obviously the advantage for your taxes as a deduction to your taxable income. And then, on top of that, you get to, lend yourself interest free, right? On that same $35,000, however that might be. And use it for down payment. Like I said, the only thing is just make sure that you've had it in there for at least, I usually say 91 days.
yeah. Okay,
Okay.
cool. And I guess the advantage to contributing to your RSPs is like it brings your income down or something. Like when
Yeah, because it's your taxable income might be less. So what your tax responsibilities might be, affected by it. Obviously, talk to a tax accountant, and I'm not one, but
you,
the idea behind it though is that you get this receipt that you can kind of deduct from your taxable income.
yeah.
Yeah.
Okay, cool.
Okay.
Okay, awesome. Well, thank you everyone for the amazing questions, and thank you so much, Ray, for coming on here. I see that like we've had people consistently watching, so that's great. And yeah, hopefully we can get together again soon and do something similar. And yeah,
I'm available when you with tequila shots next time around as soon as I
I
can.
wouldn't do it without you.
Thank you
Okay.
guys.
Thanks so much, and have a good night, everybody.
Thanks.
Cheers.